Taxes are the single largest expense for most Americans, and that is why every politician wants to get their hands on the tax code. It is how they motivate certain behaviors and actions, as well as accomplish their political agenda.
A fair tax code is how we invest things to make this country great.
We will cut your taxes even further. That's what built our economy.
So regardless of who wins the upcoming election, there will be tax consequences that directly impact you and your finances. For starters, many tax changes that were introduced as part of the 2017 Tax Cuts and Jobs Act are set to expire after 2025, which will quite literally increase taxes for almost everyone if nothing changes. So that's one situation, but both Biden and Trump have plans to change the tax code again. So what exactly are those changes, and more importantly, how will it impact you? That is what you will learn in this video. All right, so Biden basically wants to undo the tax cuts that Trump originally introduced in 2017, which he can accomplish by simply letting those provisions expire, which most will by 2026. Whereas Trump, on the other hand, plans to make some of those temporary provisions more permanent, minus some small changes here and there. So I think it will be easiest to look at the tax cuts originally introduced by Trump, and then we can tie in how Biden wants to change this going forward. So some of the biggest tax cuts that Trump introduced were, number one, increases to the standard deduction, which nearly doubled. This saved nearly all taxpayers more money in taxes without itemizing deductions on their return. Number two, the 20% QBI deduction, which granted small business owners an automatic 20% deduction against their income. Number three, higher depreciation deductions, which allow investors to write off more of their investment property, such as real estate, vehicles, and other assets in one given year. And then, of course, the decrease to the corporate tax rate, which was huge because it lowered the corporate tax rate from 35% to a flat 21% tax. And these are just some of the changes. Now, if we take all these tax cuts away, then you would assume that taxes would increase as a result, right? Less tax cuts means higher taxes. However, Biden has repeatedly stated that taxes will not increase for taxpayers earning less than $400,000 per year. But if some of these tax provisions expire, some of which directly benefited people earning less than 400 grand, then those individuals could very well end up paying more taxes as a result. So let's illustrate this. Let's dig a little bit deeper into these tax cuts. Just take a look at the standard deduction, for example, since 90% of taxpayers take this deduction when they file their tax return. So in 2018, the standard deduction nearly doubled for every taxpayer as part of the Tax Cuts and Jobs Act. It literally went from $6,500 to $12,000 for single taxpayers, and from $13,000 to $24,000 for married taxpayers. And today, after adjusting for inflation, the standard deduction is almost $15,000 for single taxpayers and almost $30,000 for married taxpayers. But remember, these increases were only temporary and are supposed to expire in 2026. Now, to illustrate the impact of this, just consider someone who was married and is in the 24% tax bracket. They would currently save about $7,000 in taxes from the increased standard deduction under the current law, but would pay an extra $3,200 in taxes if the provision expired, assuming the deduction dropped about 16 grand. Now, of course, the actual impact to you depends on your tax bracket. But if this provision expires, the standard deduction would likely decrease, resulting in higher taxes for almost everyone if nothing changes. The same would be true for small business owners who use the QBI deduction, which again expires at the end of 2025. This tax deduction grants small business owners an additional 20% tax write-off against all of their business income if they qualify. And speaking of people who qualify, taxpayers who earn less than $180,000 automatically qualify if they are single, with a business, or if they are married with less than $360,000, they also qualify, again, if they earn business income. For example, if you are a single taxpayer and earn $150,000 in business income, the QBI deduction alone would grant you a $30,000 tax deduction. And if you are in a 24% tax bracket, then this would save you $7,200 in taxes as a result. Again, this is another example of how someone earning less than $400,000 in income may end up paying more taxes if and when these provisions expire. Now, another big change that will affect small business owners and investors are the changes to the depreciation deduction, which has already begun phasing out since 2022. Now, if you don't know, depreciation is a non-cash expense that allows you to write off a portion of assets you own each year. But the Tax Cuts and Jobs Act introduced 100% bonus depreciation, which allowed business owners and investors to write off up to 100% of certain business assets they purchase in one given year. This provision increased tax deductions for people buying various things like rental properties, business vehicles, equipment, and other tangible assets through their business. Because instead of writing off these costs over 5, 10, 15, or even 27 years, this provision allowed them to write off 100% of those assets in the first year. For example, in 2022, you could buy a 6,000 pound SUV for your business and write off 100% of the cost in 1 year, as opposed to writing off 20% of the cost each year over a 5-year period. Which means if you bought a $60,000 work van, you would receive a $60,000 tax deduction in the year you bought it, as opposed to a $12,000 depreciation deduction, which was big before this started phasing out. But at that point in time, if you were in a 24% tax bracket, the extra $48,000 in tax deductions would save you literally over $11,000 in taxes alone. However, this temporary bonus has been decreasing by 20% each year since 2022 and will fully expire by the end of 2026 if it is not extended. So this is something that I think may be a part of Trump's plan. And then there is the corporate tax rate, everyone's favorite, which was decreased to 21% under the Tax Cuts and Jobs Act. And Trump wants to decrease the tax again to 20%. Whereas Biden, on the other hand, wants to increase the tax to 28%. Now, in general, if you don't know, C corporations are very attractive from a tax perspective because they are taxed as a separate entity. For example, someone who is in the 37% tax bracket could create a C corporation and have their income taxed at 21% instead of 37%. That is, if they do not take any distributions from the C Corp anyway. So if the corporate tax rate is increased to 28%, it would make it more difficult for people to take advantage of the differences in tax rates amongst corporations and individuals. So with that said, let's fully turn our attention to Biden's tax plan. Now, as I mentioned, I don't know if I fully believe that taxes will not increase for everyone under Biden's tax plan. But what I can say is two things in particular. Number one, people who earn over $400,000 per year in income will face much higher taxes under his plan. And number two, people with lower incomes will be granted more tax credits and deductions for sure. So let's talk about it, starting with increasing the individual income tax rate. So Biden wants to increase the top individual tax rate to 39.6% on incomes above $400,000 if you're single and $450,000 if you file joint with a spouse. Now, for context, single and married individuals who earn above $400,000 per year are already taxed at about 35% until they earn over $600,000 or $700,000, which is then taxed at a max rate of 37%. So this increase will result in them paying anywhere between 2.6 and 4.6% in extra taxes on income above these levels if this is passed, which will result in several thousands more in taxes for the impacted individuals. Now, the next big tax change in Biden's plan is to increase the capital gains rate for individuals who earn over $1 million in income. Currently, long-term capital gains and qualified dividends are taxed anywhere from 0 to 20%, depending on your income. But Biden wants individuals with more than $1 million in income to pay ordinary income tax on their gains, which would subject them to pay up to 39.6% of their gains in taxes. So if you sell a small business, you sell some real estate, or even stocks for more than $1 million in gains, you will be subject to much higher taxes as a result under Biden's tax plan. And the last big tax hike, anyway, is something that surprises many people that I work with: the net investment income tax. Now, many people do not realize that they actually pay this tax, and it completely catches people off guard who do realize it. So under current law, single taxpayers who earn over 200 grand in income and married taxpayers who earn over 250,000 in income pay a 3.8% additional tax on their investment income, which includes interest, dividends, capital gains, rental income, and related income. For example, if you already have a 20% capital gains tax, it is very possible that you will incur an additional 3.8% net investment tax if your income is above these levels, resulting in an overall 23.8% tax. But wait, now Biden wants to increase this tax again to 5% for people who earn above $400,000 per year, which again will simply result in thousands of additional taxes on people who earn higher incomes. Now, these taxes affords Biden the ability to provide more tax benefits to families and workers. For example, his plan is to increase the child tax credit to $3,600 for young children and $3,000 for older children. He also wants to make the child tax credit fully refundable, which is big. And he also wants to increase the earned income tax credit, which will help a lot of people out, amongst several other tax policies. Now, as I have stated, regardless of whose plan you support, it is important for you to be fully aware of these changing tax laws so you can minimize your tax liability at the end of the day or maximize your tax refund. And if you are a business owner or investor that needs help with this, then just apply to become an exclusive client of mine today at mycpacoach.com.